Good morning, this is Kim, and today I want to continue our conversation on bonds. I have a page up here. We're going to start with corporate bonds. But first I'm going to remind you that bonds are a loan. Remember, it's a loan that an investor gives to either the federal government, state or local government, or to a corporation. So we're looking at corporations now. So written pledge to repay a specified amount of money with interest. And if you remember, a bond par value was $1,000. So you would give a company a certain amount of money for a loan, and in return, they're going to repay you par value at the maturity date. Okay, it's considered safer than stocks. That's right, because we know its area on the pyramid, and it is considered safer because of that interest payment. Bonds are called, bonds and CDs and savings accounts are all called fixed income security. Okay, fixed income because it has that interest component. And again, from the video, it's a form of debt financing. All right, this is all review. Face value, $1,000, receives at maturity. The coupon rate is the interest on the bond. Interest payments are made every 6 months. So if you had a coupon rate of 6%, that would be $60, and you would receive $30 every 6 months. And finally, the maturity date is when the face value is repaid. Okay, I'm going to skip to here. We're going to talk about why corporations sell bonds. Should be reviewed to raise money for a big purchase, for research and development perhaps. It could be for a number of reasons. They've decided to sell bonds instead of issuing stock. Again, when you want to expand your business, you're going to need a large sum of capital. So this is just one way to receive a large sum of capital. And then right here, interest paid to bondholders is tax deductible. So there's another incentive to bond finance. Okay, I think I'm going to pop over here to a bond quote. So this is a real bond quote, and I think it'll help explain a lot of things. So let's say you're looking for a bond and you find this quote, and this is Home Depot. You all know Home Depot. Now, when bonds are quoted, you can see that this price right here, $93.51, doesn't look anything close to a price that we would expect, which is something near $1,000. And in fact, it's not. Prices are quoted in percents of 1,000. So you're going to think of this as 93.51% of 1,000. So this 93.51% of 1,000 equals $935.10. Effectively, you can move the decimal over. However, you could have done multiplication and figured out about 93% of 1,000 is $935. But the quick way is to move the decimal over one place to the right, and this would be the price that you would pay for the bond. So quotes are in a percent of 1,000. This is the actual price of the bond. The coupon rate for this bond is 5.875%. So that means the annual coupon payment, if you remember the coupon payment, so I'm going to write down here payment, so I'll spell it out, equals par value or face value multiplied by the coupon rate. So in this case, we always know that par value is 1,000 multiplied by 5.875% equals $58.75. So that would be our annual payment, our interest payment that we receive on this bond. We know that this bond matures, for this, it matured in December, I'm not sure about that date there, in 2016, and December 16th, oh, I'm sorry, this matures December 16th, 2036, so it's way out there. And what we haven't talked about yet are yield to maturity and current yield, and they're very important. First one I'm going to go over is yield to maturity. I want to note that the yield maturity here is 6.365%, higher than the coupon rate at 5.875. So why is that? The reason is because you're going to receive the $58.75 each year as part of the interest payment. But remember, you purchased this bond, this particular one, at a discount because you only paid $935.10. But you are going to receive at maturity $1,000 because when a bond matures, you receive back par value. So in effect, you're going to gain about $65 here at maturity. And the yield to maturity takes the price that you paid into consideration. Since you bought the bond at a discount, your yield to maturity is going to be higher than your coupon payment because you're going to receive this additional money here. The difference between $935 and $1,000 at maturity. So that really is, if you hold the bond to maturity, that's going to be your true return. Current yield is just the current, it only takes into consideration the interest payment and the price for a year. So it's down here, but if you took the $58.75 or the coupon payment and you divided it by the current price, you would see that your current yield, if you held the asset for a year, is 6.283%. Again, higher than the coupon payment because, again, purchased the bond at a discount. Okay, so those are current yields, yield to maturity, and you really, it's important that you know this formula for current yield. We're not going to be required to learn yield to maturity, but we do need to know the formula for what is the current yield on the bond. Okay, and lastly, you see here something called rating, a Fitch rating. So all bonds are rated. They're rated AAA, AA, Bs, Cs, etc. And the rating is important. It's an indication of how likely this company is to pay. So will they be able to pay the coupon payment and then the par value at maturity? And companies rated A's are considered highly likely to pay. So if you think of A's are the highest, and then we have B's, so they're not as high as A's, but that's not necessarily a bad thing. It's just that their financial statements are not as strong as the A's. And then the last rating we have are C's. Now, a C rating is something different. Anything below a B is considered a junk bond. Now, a junk bond, because it has a C rating and may have difficulty paying coupon payments and par value at maturity, receives this low rating, but in return offers you a much higher coupon rate. So again, in terms of risk, since C bonds are really a lot more risky than A's or B's, the company or corporate bonds would have to compensate you for that risk. And the way they compensate you is to offer you a significantly higher coupon rate. So junk bonds, if you're willing to buy them, you should expect a significantly higher coupon rate for taking that amount of risk. So again, Fitch rates bonds, also Standard & Poor's and Moody's. So there's 3 rating agencies for bonds, and they are all letters. Versions of A, versions of B, and C bonds. So again, if you are a very risk-averse person, you would only consider maybe A's and high B's. If you are more risky, maybe you'd look at junk bonds. But in reality, none of you in here are going to be buying individual bonds in the near future, but you do need this knowledge so we can understand funds, mutual funds, when we move on to our next topic. Okay, the other thing I want to talk about here that's not on this quote page, is a feature called a call feature. Just like it sounds, a call feature. And a call feature is going to be either yes or no. If a bond issue has a call feature, and let's say out here we had the call feature and it said yes. What that means is that at some defined period, Home Depot can call these bonds in early. In other words, this maturity isn't till 2036, but let's say Home Depot decided that they wanted to call these bonds in early and just pay you your par value back. They could do that. If it has a call feature, it was written into the bond when it was issued, and they can call it back. If it says no, then there is no call feature, and you know that you will be able to hold this bond till 2036 at that coupon rate. Now, why would companies want to call in a bond early? Well, think about this. Let's say that interest rates overall were significantly lower than 5.875. So Home Depot could actually reissue a new set of bonds at a lower interest rate and then go in and pay all these off. So, or maybe they just have a lot of extra money, they made some great investments, and they don't want to carry the debt anymore. They could actually pay it off early if they had written a call feature into this bond issue. All right, the other thing you notice is Home Depot has issued bonds once, twice, 3 times, all with different maturity dates, and that's okay. It doesn't mean that Home Depot is doing poorly. It just means that Home Depot is in need of extra money, hopefully to expand their business. So that's kind of a nutshell of a quote for a corporate bond. And then I'm also going to provide you a PowerPoint presentation, and it has these slides on there. And in fact, I'm going to pop into that PowerPoint presentation right now. Okay, so we talked about this, but I'm going to now go back up to the top here. And let's just do a quick summary of bonds. Okay, government bonds, again, sold to fund the national debt or whatever ongoing costs of government. We have federal government, state, and local, and all 3 entities of government issue bonds. So the first set is the Treasury. We already talked about T-bills. They were part of our cash equivalents. I do want to note here, federal tax, but no state tax on interest on T-bills. Next, we have notes, Treasury notes. Again, the maturities here are higher than the T-bills. T-bills mature 1 year or less. Treasury notes, these are bonds issued by the federal government, have a 2-year, 3-year, 5-year, or 7 maturity. Interest is paid every 6 months. Again, a higher rate than T-bills because they're holding on to your money for a longer period of time. Again, no state tax on interest. By the way, these are non-callable. All Treasury bills are non-callable, and they're all AAA rated because the federal government can always pay its bills. Next, we have bonds. These are just, again, another, instead of note, it says bond here, and it's just because the maturity date is significantly longer. And then lastly, we have another type of bond issued by the federal government called TIPS, Treasury Inflation Protected Securities. And these type of bonds adjust based on the inflation rate. So if you can think of a hedge, these are a way to mitigate your risk when we're in a period of high inflation. So these, in some cases, are great for a portfolio, but probably not for a lot of your portfolios right now. Let's just go to the summary. So here are all the 4 different types of Treasury securities: T-bills, notes, bonds, and TIPS, and a summary of all of these. Again, in reality, you're not going to be buying these individual bonds, but when we move on, you will see a lot of these bonds in funds that we are interested in buying. So just make sure you understand that the government does issue bonds, and there are different types, and that their interest payment is exempt from state tax. Okay, the next type, state and local government. They're not called state and local government bonds, they're called munis. So think of them as munis. And the big difference between a muni and a federal bond is taxing. Okay, so a muni bond, I'm going to skip down here, is tax exempt from federal. So when you, for example, there was a bond issued to build the Golden One Arena, okay? And that bond, if you were to buy a bond that was issued to build that marina, the interest would be exempt from federal taxes and state taxes. So in other words, if you buy a muni bond from your state that you live in, it's exempt from both federal and state and local taxes. So there are some key benefits to muni bonds. And I'm going to talk about this next week when we talk about strategies for buying or avoiding taxes, because lots of people who make lots of money are interested in muni bonds because they don't have to pay federal or state taxes on the interest. So that's just something to think about. That is one of the key characteristics of munis. Here is that taxable equivalent yield, but I'm going to do this in a separate video because it's more complicated than just looking at this equation. So, but do understand, treasuries are exempt from state taxes. Again, munis, state and federal. Okay, and then we were back into corporate. So this is sort of a high-level view of bonds, and it's just a loan. It's makes you more money than cash equivalents, and but it's significantly lower risk than stock. So I'm going to stop this right now and go over your homework. Thanks.